Hello, welcome back to the Midnight Markets podcast. My name is Sofia Cruz, your host, and today we have an amazing guest. Oscar, tell us more who you are to our audience.
Of course. So nice to be here today. My name is Oscar. I am the fund manager for the GW Stock and Portfolio Management Club. I'm a junior at GWSB. I double major in applied mathematics and finance. Other than that, I'm going to be interning for markets at Citi for next summer, which is very, very exciting. And I'm very happy to be here, happy to chat.
That sounds really, really exciting. What got you into math? What got you into the math and finance that you're currently doing now?
Yeah, so I was always very interested in mathematics as I guess even an elementary school student. I thought that just solving a problem using mathematics and Boolean logic and arithmetic was very fascinating. Especially a lot of people hated word problems. I loved them. I loved being able to take a situation that was real and tangible and then apply some sort of rule to simplify it and apply it to the real world and provide a real solution. Other than that, in terms of how it applies to markets, I always thought that applying mathematics to markets and devising these fascinating pricing strategies and these algorithms that these prop and hedge funds use was something that really always drew me in. And that really only developed when I got to GWSB, joining SPMC, but also taking introductory finance classes. I realized what I loved about finance was less so the people, although I love people. It was more so the math. It was really more so the math and the computation.
Well, yeah, when we talk about finance, we also have to talk about the people, but specifically nowadays, we're looking at a lot of trends about algorithmic trading. We're looking at things that we didn't used to see a long time ago. And you're bringing something new to the table when you're telling me, oh, since I was a kid, I had this huge idea of doing math, and just now this helping you so much achieve your goals in life, right?
Yeah.
And right now, you landed a role at Citibank, you told me, right? But right now, there's a lot of uncertainty in the market for, let's say, young people like us. There's a lot of fear of rejection. There's a lot of rejection, actually. But if somebody's behind the screen right now and this person wants to know, what did Oscar do different than people that have not gotten to land a position like Oscar? What did he do different?
So I'll say the first thing is something that I think many people are doing is not unique to me, but it really is a numbers game, especially when it's getting more and more competitive. You just have to be putting out as many applications as possible, but before that you're sending as many emails as possible looking to network. As many of those emails have to turn into calls, as many of those calls hopefully turn into relationships and people who can vouch for you from the inside, because that's really what's going to set someone apart. If they have people at the inside of not necessarily even just the bank, the hedge fund, the prop fund, the financial services company, if they're saying this kid, this student, they're bright and they have it, in their soul, then that's valuable. That's something that really makes you stand out. That's something that I did. I'm sure everyone who's recruiting can hopefully relate, because they should relate. Staying up, writing emails, trying to respond within 1 to 2 hours because these people are busy.
Yeah.
One thing I'll say that I think hopefully I did differently, not necessarily sure I did, is I think it's very common for people to prioritize studying for technicals, and you absolutely should study your technicals. But what really will differentiate you in a super day, at least in my eyes, is the behavioral aspect. Because everyone at the super day is polished, they are prepared, they've made it through the first round and through the recruiting review. So it's more than likely they are ready for this event. So what's going to make you stand out as an individual is how you resonate with these people on a more personal level. One thing I did, and I'm not saying everyone should do this because it's very me-based, is I'm a big rock and roll fan.
Okay,
and
rock.
It was always in my interest section, the first thing, rock and roll. When people asked how I'm doing, I would talk about a show I went to recently, and that would make the beginning of the interview, which can feel really awkward, especially over Zoom, just feel like a natural conversation. We talk about our favorite bands, our favorite songs, and the rest of the interview just followed that tone. It was a very, very pleasant conversation many times. That's what I really think allowed me to get along with these people. And I'll say the third thing is also to just come at it with a positive attitude. When you see, maybe this was definitely the case for me, when you see people on LinkedIn and in class getting offers while you're still in the weeds, it can be really disheartening. But the key thing is to understand that everyone's process is different, and you can't really base someone else's success and directly compare it to your situation. Other people have different strengths, different weaknesses, and frankly, different luck. So I think it's very important to not be bogged down by other people. Absolutely, if you're someone who studies well with people, recruits well with friends, then do it. Absolutely. But if you hear someone's success story, don't necessarily think, oh, they've taken my spot, my numbers are getting lower and lower. You should really just try to stay kind of in your path.
People are analyzing how you will behave with them if they were to hire you and to be in the office with them. And they don't want somebody, everybody knows their math, as you said.
Yeah.
Everybody has gotten really, really well prepared, but at the end of the day, that's how it goes. I mean, now that you're looking forward to your next summer, do you look at specific trends or things that have gotten your attention? I've heard a lot of young people talking about buffer ETFs lately, and I would really highly appreciate if you would tell us more like what you think about these. Are these forever to stay or just a trend?
Yeah, buffer ETFs are something that's always been, I guess, a product for retirees, and I'll explain why. It's because buffer ETFs provide the benefits of an ETF, which is exposure to, in most cases, the equities market, but ETFs can provide exposure to other markets, but they're also able to cap your downside. The way it works is you buy into a buffer ETF as you would any other ETF, really, and there's a degree of protection, say 15% for the S&P. A lot of buffer ETFs are tied to equity indexes. And what that means is if the holding you have within that ETF dips to or less than 15%, you're completely protected. So just to illuminate, you put $10 into an S&P buffer ETF with 15% protection, market goes down 14%, I still have my original investment. But they're also capped for the return. Usually this will be higher than the protected range, so it would be something like 17 is a fair number. And what will happen in this case is if the market rallies to 18%, I'm still stuck at that 17% gain. That 18% is unrealized to me, which is why it's popular for retirees, because they have, to an extent, guaranteed protected downside to a certain amount. But again, they get that stable income. They're usually a yearly product with new offerings being released every year. The way they do this is through options trading, the underlying mechanics. It's buying protective puts and covered calls in order to cap a downside and provide protection for the upside. But yeah, I think a lot of young people have been drawn to them, or really all investors, because of the volatility we're seeing in the market, still wanting to gain exposure to the equities market, which goes through its periods of booms and busts based on tariff and Fed news, but also wanting to protect against that same volatility, because it really is a double-edged sword. And that's why I think we're seeing a lot of interest and capital inflow and even innovation. I was reading this morning, apparently there's going to be a firm that's launching dual direction protected buffer ETFs. So you'll have capped and protected both downside and upside, which will be interesting.
That's going to be really, really interesting. It's something that we cannot control at the end of the day. And sometimes listening to somebody who helps us like understand what it's taken, like in this case you, what it's taken you to get to these conclusions, it's really like helpful for people, because it's not just, oh, actually I just think this, but you're actually backing it up with facts. And I really want to get your take on the Fed, because a lot of people are saying, oh, the Fed is actually is dependent on government actions and decisions, right? These are some takes from people out there, but I really want to get your take on what could happen and what if the Fed was to say, oh, I'm actually gonna cut rates. There are specific things like Bitcoin, let's say,
Right.
that could get affected, but in which way would it be positive or negative for you?
So just looking at it in a vacuum, hypothetically, to the technical, what will happen from an econ standpoint is if the Federal Reserve cuts rates, that means that we're going to see a lot more outflow from these rate-dependent assets like fixed income, because oftentimes when rates are raised, fixed income raises their interest to sort of compete with the Federal Reserve, and as a result we see inflow. The opposite would happen here. And so hypothetically, you would see an inflow into something like Bitcoin or something like gold. Usually gold's the big winner because gold isn't an interest-bearing asset, and it's also seen as a risk-averse asset, which is where I move sort of to our current situation. Because of sort of I guess I'll say, this is the word everyone loves to say, but the uncertain environment we're in, as common as it is true. Regarding what's going to happen with tariffs, regarding what's going to happen with the Fed in September, I think we would actually see a huge inflow into Bitcoin, as well as gold, because when rates get cut, not only are traders and investors and speculators concerned about what's going to happen going forward with interest rates. Whenever the government introduces a new tariff or perhaps a new tax on corporations, the Federal Reserve has to incorporate all of this information to its data. And they can't control it and they can't influence it, but they have to play around it. And what's going to happen with tariffs, potentially, and one thing that I've been following, is a lot of economists are afraid if the Trump administration were to suddenly roll back tariffs, which have sort of been priced in and incorporated as this huge revenue stream, a lot of our GDP projections could really, really waver, and they could really, really peter out, which is quite frightening for someone who is a fixed income investor, as a lot of these longer duration fixed income instruments are tied to future growth prospects. And if future growth prospects for American GDP are gloomy, that's also a great reason to invest in Bitcoin, the, quote unquote, super decentralized asset. When people think crypto, they think decentralization, and they really think Bitcoin. So in short, I think if the Fed cuts rates, and if things play out with tariffs in the sense that the Trump admin will roll them back or scale back, we could see a huge appreciation for Bitcoin, which has already done remarkably well since the start of the Trump presidency. And I think gold will follow, as gold's been continuously rallying to new highs.
New highs, specifically today.
Mm-hmm.
But when we talk about any currency, right, when we talk about the dollar, the pound, lately we've seen the UK not so great. And we tend to see, these big countries are doing so well, so what's the best out there? And investors tend to look for Bitcoin and decentralized assets, such. Yeah. No,
it's interesting, the big currency question. A lot of people, particularly they call themselves probably Austrian economists, they think that there really shouldn't be a Federal Reserve. They believe that currency isn't something that should be controlled by the government, as the Federal Reserve, through its mechanisms of open market operations, can drive inflation. And, that ultimately reduces how much people make, like, in reality, because perhaps I get a raise of 2%, but if annualized inflation is up 3% for the year, that's been completely, shadowed over, and I'm actually making 1% less than I was. And the reason that I think Bitcoin is only half the solution is, on one hand, you don't have to necessarily worry about governments, or really any entity manipulating the markets in order to change the price, whether that be using Bitcoin as currency or having the dollar pegged to the value of Bitcoin, how it was with the gold and bullion standard, where you could exchange a dollar for its worth in Bitcoin versus bullion. I think it's only half the solution, because the cryptocurrency market can still be manipulated, in the sense that people are able to take out large orders and drive prices. The cryptocurrency market is one of the most speculated markets, frankly, at least in my opinion, as people play on events like the Fed cutting rates, tariffs, adoption by countries for cryptocurrency, and all these other macro events going on that really drive the price of Bitcoin. And that makes for a really volatile asset. And that's why it's not as good in some people's eyes as something like gold, which has been a lot more stable, definitely been growing rapidly over the past few months, but has had a much more stable trajectory than something like Bitcoin or any crypto for that matter.
Yeah, and going back to all of it, really, we're looking at a lot of macro and a lot of trends that are becoming more popular now due to volatility. When you inform yourself, what resources do you look for? Of
course. So number one, the Midnight Markets podcast. Number two, I'm a big fan of Seeking Alpha's Wall Street Breakfast. The reason I like them is they're another podcast. They do pretty short episodes, which is great for me because I'm able to listen to them in the morning. They do Wall Street Breakfast, which is a recap of everything that's happened overnight, or something that's slated for the day, such as a macro data report. And then they also have Wall Street Lunch, the second episode of the day. This one releases later on, and it covers things that happen during the day, and things that are expected post-market close, which is great for something like earnings to hear expectations. Other than that, I'm a big fan of Bloomberg. I just happen to like the way that their articles are written. They're a bit more technical than the Wall Street Journal. I also do read some of Seeking Alpha's content, but it can be really, really jargony, which isn't always a bad thing, but sometimes it can just feel like alphabet soup reading through an article. So I'd say those are really my main three. It's also really just helpful if you're someone who's interested in going into markets to trade and invest, because that really just motivates you to stay up to date with what's going on in the markets. Because, I mean, your money's on the line, and if you're not informed, then it could be scary trying to get a return that way. So it's a great motivator, and it's also a good habit.
Motivation and pressure too.
Of course.
You get it. And you were talking about Seeking Alpha. I love Seeking Alpha. Yeah.
I'm a big fan.
Me too. It sometimes it actually becomes more like, oh, actually I didn't know this information about this. Let me read more, and you feel like you're reading something that's really, really that really captures your attention. But yeah, pretty much. But if somebody is going through, let's say, going back to recruiting, and so they really want to go to Wall Street, and what specific resources are people in Wall Street using? Yeah.
So in terms of resources that are used on Wall Street, speaking to GW, which I'm sure is the vast majority of our audience, I really recommend getting involved with the Investment Institute. I'm not promoted by them or anything, but at least in my experience, it was really helpful to do their portfolio group, which is where I was able to get my FactSet and Bloomberg certification, especially Bloomberg, but FactSet as well, are heavily utilized on Wall Street. I cannot emphasize how critical Bloomberg is to literally everything on Wall Street. So being able to get hands-on experience and using Bloomberg as well as FactSet to analyze securities, to deliver presentations based on recommendations using the data that you got from there, I think is something that really sets you apart and gives you the skills that are used on day-to-day there. Granted, in a very different environment and very different conditions. However, the mechanics and the operating are very similar. So I definitely recommend, if not through the Investment Institute, being familiarized with a Bloomberg terminal. We have them on campus. Just play around with it, understand how to operate it, how to analyze markets, and that will really set you apart. That's number one for sure. Other than that, a lot of people, at least traders and salespeople in Wall Street, they sort of have their own preferred methods of gaining information. During recruiting, I'd very often ask, where do you get your news from? I heard some people say Seeking Alpha, some say Bloomberg, some say Wall Street Journal. It was a plethora, and I don't really have one that really stood out because everyone had a different opinion. So I think the key is really less so the information you take in and where you get it from. That really comes down to personal preference. But what will set you apart is being able to understand it. Not just to read a headline like, oh, Jerome Powell thinks the PCE is going to come in at 2.9. This is good for cutting rates. It's being able to say, okay, the PCE, that's one of the preferred measures of inflation for the Fed. If it's at 2.9, that's at expectation. That means he's probably going to cut rates. If it comes in at 3, they're probably not going to cut rates. What's that going to do? It's going to cause a rally in the fixed income market. The market's priced in a rate cut. That's not accounted for. So being able to think of something like that as opposed to just cutting and pasting what you read that morning into an interview will really set you apart.
And if somebody, let's say, wants to get just one thing out of this podcast that you really would like to tell your Oscar of 2 years ago, let's say, Oscar, listen to this advice, what would you tell yourself?
I would really say just get started early. I think a lot of people wait too long to get started in the networking. In my personal experience, I'm not saying that this is when you have to start. I started in October, which is a lot earlier than a lot of people were, at least people that I knew, which gave me a huge leg up because a lot of these alumni, whether it be at GW or other schools, as soon as recruiting season starts, they're just inundated with emails in their inbox, sometimes LinkedIn message requests. And it's really nothing personal at that point if they don't get to you. They just have emails to go through. So I think just getting started early and being able to foster connections is something that I'd recommend that I would have done. Perhaps I should have started even earlier. I also think another thing that I really didn't learn till later that I touched upon before is don't overemphasize technicals. You have to be technically sound, but it's very important throughout the coffee chat / recruiting process, as well as through the interview process, to just be someone these people would like to be around, especially for something like sales and trading, which I hope to go into. Salespeople and tradespeople and clients, it's pretty much just a non-stop communication feedback loop. So it's extremely important that you're able to be someone who's pleasant to be around, someone who's sociable, someone who really understands how to interact with people in this business setting. And I think that's something that I really should have done earlier. I think I should have prioritized personability and coming across as a lot more friendly in interviews, because it's natural to be nervous and sort of freeze up and be more robotic, which is not how people are, and they understand that, but you have to sort of break through that mold.
Mm-hmm. Well, that's really, really great advice for anybody, really, because you never know when opportunities arise, and this is great for all of our analysts and also people listening at home. Yeah. Well, thank you so much, Oscar. And I really want to say thank you to all the people who have joined, and you specifically, who got a lot out of this podcast today. And I'll see you next time.
Thank you very much. Thank you for having me.
Yeah, thank you.